All right. Welcome back to the Brutally Honest Loan Officer podcast. I am Derek Brown. Stephen Brock is here. Say hi, Stephen.
Hi, Stephen.
You stole my joke.
I did. I did.
Welcome back, everyone. Thanks for tuning in. Stephen and I are loan officers here in Florida. We work for the mortgage firm. We've got another podcast episode coming your way. First, I want to ask Stephen an important question. How was your 4th of July?
It was great. We went over to Naples. My dad has a condo over there, so we stayed over there. It was like 2 blocks from the beach, so we went to the beach a couple of days, hung around there, went jet skiing, saw some dolphins, but just relaxing, kind of almost like a staycation kind of thing.
Yeah.
So it was good. It was good. What about you?
We went to New Smyrna. So we had like a little house for a week. But the setup was incredible. So like, I don't know, are you familiar with New Smyrna? Okay. Um, it's a beach that's close to us. It's like 35, 40 minutes away. But where we stayed was in Outriggers, and Outriggers has like, you can launch a boat. They've got a full-blown restaurant and bar. And then they also have like small houses. Well, not too small, but because ours, it was like 3 bedroom, 3.5 bath. But it was awesome because we brought our golf cart so we could just golf cart to the beach, and then we came home, took like little kids took naps, then we went to the pool, and we were at the pool like feel like having a pina colada, so went and got pina colada from the bar, and then we were like, but essentially like that's on property, like so then we would just go home. So like all of our meals we made, we had two
Yeah.
dinners out. So, I mean, as far as like saving money on food and stuff like that, super easy. And then they had a huge July 4th celebration, um, where they had like a live band and a bunch of different games. Kids got their face painted, stuff like that. And then a huge fireworks show. So we had some friends come and join us. And I don't know, man, it was perfect. It was probably like one of my favorite family vacations we've ever done.
Nice. Well, I guess
And I think
maybe
I think we've booked it for next year.
nice.
I know
So
my
I
wife was
think
trying to compare like a couple of the different houses to rent, but
she might, yeah. She'll probably just book it. She won't even tell you. You'll just know.
and if there's anybody listening thinking about doing that, just do it after we book ours. Okay.
Don't book when I go. That's all I care about.
Yeah.
Well,
We've got another big shout out too. Shout out to our buddy Roscoe, who we just found.
yeah.
Well, I just found out via social media he's having a baby.
Look at him go. And the social media part too. He's
Yeah.
been real big on social media lately, but super proud of him. Gonna be a dad soon. I don't think they only announced that they were having a baby. They didn't announce the boy or
No,
girl
just
yet. Yeah.
no.
So yeah, I know he's been
Just
talking to me a little bit about it, like, oh, how do you juggle kids and that? I'm like, you gotta do what you gotta do.
figure it out. You just
You
figure it
might
out.
you might have an 8 hour workday that's only 4 hours long that you gotta knock all of it out, but it's what it is.
You
So
you figure it out.
that's it. That's parenting. Figure it out. So what is our topic for today?
Mortgage insurance. Super
Oh,
exciting. Buckle
that's
up. This is an exciting topic. uh,
so excited.
it is probably on the majority of loans that I do. We do help a lot of first-time home buyers. A lot of people putting less than 20% down, but that's typically it. If you put less than 20% down on a home purchase, you're required to pay private mortgage insurance. So it's and if you're wondering why, it's the insurance for the lender in case you default on the mortgage loan. It's insurance there, so they can receive some money back. But if you're doing a conventional loan, you could probably expect to pay $30 to $70 per month for every $100,000 borrowed.
Yeah.
But that's on conventional.
Yeah, so with conventional, it's that now FHA has a little bit different rules. They have insurance premiums that get paid up front and annually. So you have your upfront premium, which is 1.75% of the loan amount, which gets built into your loan. So a lot of times you'll see it as, hey, I'm buying a easy numbers, a $300,000 house, but or I mean, let's just go $100,000 house, 3.5% down. My loan amount, should be 96 something, but it's higher than that. Why is that? Because that premium is put into the loan with it.
Creates a total loan amount. Yeah.
Yeah. And then you have monthly premium, which went down, what, 2 years ago?
Yeah, it was 0.85, then it
Yeah,
dropped to
yeah.
0.55.
So monthly premiums now is 0.55% of the loan amount with it. So it depending on, what you're doing, your credit score, FHA sometimes has the lower amount than conventional. So it definitely can be beneficial to people.
Well, and I've seen customers that are doing conventional because there's a couple factors that go into it: your debt to income ratio, your credit score, your LTV, which is your loan to value, or your down payment. But I've had some people that are they're wanting to put 20% down, and we're doing a conventional loan. They have good credit, but like that would almost take like a lot of their savings. So then we like look at the numbers, putting 10% down, and let's just say on a $300,000 loan, that mortgage insurance could be super cheap,
Yeah.
like $40 per month. And they're like, wait, what? I'm like, yeah. So if you think about $300,000 loan, 60 grand is 20%. So like if you just want to avoid paying mortgage insurance, sure you can by putting another 30% down if you're putting 10%. But when we look at the payment being, 30, $40, you're going to spend 30 grand to save $40 a month. I just don't know if that sole reason is worth it.
Yeah,
You know what I mean?
exactly.
So there's a lot of times where, you might be able to save some money in the bank. Um, your payment might be slightly higher, of course, putting less down. Um, but yeah, and then there's a couple other differences between conventional and FHA. For FHA, it's for the life of the loan, right?
If you put less than 10% down, FHA PMI stays on for the life of the loan. If you put 10% down or more, people are, oh, first of all, everybody thinks FHA is for first time home buyers. It's not. It's just, you just don't fit in the conventional. A lot of first time home buyers use it, but not always the case.
Right.
So there are people that have plenty of money to put down. Even if they're a first time home buyer, they have more money to put down, but they might have, bankruptcies or something in the past that conventional can't go. So it has to go FHA. So FHA AI, if you put more than 10% down on the 11th year, so after 120 payments on that 11th year, it will fall off
Right.
automatically if you had 10% down.
Gotcha. And then with conventional loans, you can potentially cancel the MI after a certain amount of time. So the rule is it automatically comes off once you reach 78% LTV. But this can take a really long time because what they're looking at is that LTV. So let's just say a $320,000 purchase. 80% would be 256. If you look at your amortization schedule, once you reach that remaining loan amount of 256, if you were to just make on-time payments and everything, 10 years. It could take 10 years to
If
get
you're
there
putting, was it
for it to
5% down? You're right. You're
yeah,
spending like
put
5%.
5% down. Yeah,
Yeah.
so
So saying, oh, it's almost like FHA then. On that 11th year, it would fall off kind of thing.
right.
Automatically.
But one of the great things about conventional loans is, after 2 years, a lot of times, let's say you put 5% down or 10% down. After 2 years, you might have that 20% equity. So
Yeah.
can you
That
remove it?
you could have it removed then. So what he's saying is you put 5% down and then 2 years you can request for it to be removed because you have enough equity. Well, Eric, you just said it takes 10 years to get that equity. No, the market, it goes off of what your house is valued at on the current market. So as it increases over those 2 years, your loan to value of the loan amount you have left and the value of the house currently will actually be what they determine. So they will either look at it and say, hey, yes, we can do it. We need to order an appraisal. So you got to pay for an appraisal to have
Right.
that dropped. Or they're going to say,
Usually it's a little
hey,
bit cheaper than like they
sometimes
might
it's
be
just a
doing like
desk
a
appraisal.
desktop appraisal or
Yeah.
something like that. So, a
It's
couple
anywhere
$100.
200 to 600, depending on what kind of appraisal they need to do.
Right.
They'll come back and determine what it is. And then, hey, yeah, you have the 80%, or you're at least 20% down now. We're going to remove the PMI. Sometimes they put it in the system and it says, hey, they think it's worth this already. They're going to remove it. So you should always ask. I actually recently had a friend of mine that works for the realtor board that we were doing an annual mortgage review, and I looked at his stuff and I'm like, you need to request this. And he called them up and they dropped it on the spot. They just typed it in, said, "Yep, it's worth it." Dropped it, saved him $100 a month for the life of the loan.
That's awesome.
So
Yeah,
yeah, you're
and I
definitely
mean,
gonna do it.
sometimes we've done conventional loans, depending on their credit score and how much they're putting down, stuff like that. We're talking like a significant amount of money, $300-400 per month sometimes.
Yeah,
So to have that removed, big savings, big savings. Um, okay, and now we're talking about removing it, but if you didn't want to pay it monthly, could you pay for it up front?
yeah, you could.
Sure can. So imagine, like, let's just use a scenario, you're putting 10% down and then you want to pay for the mortgage insurance up front. We can get quotes from different mortgage insurance companies to see what that would be like, and it might be just, a few $1,000s. The last time I did that, we were doing 10% down. It was like a $400,000 purchase, and the mortgage insurance upfront premium to pay was like 7 grand. So instead of putting $80,000 down to avoid it, they paid like 47,000
Yeah,
between their down payment and the mortgage insurance upfront cost. Then they never paid a monthly fee,
you're
and
good to
that's
go.
what they wanted to do. They were adamant about it. Sure, we
Yeah.
can do that.
We'll run the numbers for anybody and show, hey, this is what it looks like. It's up to you to make that decision. Like, hey, I want to do it monthly. I want to do it up all up front. You just kind of have to know your ROI on it. Like, hey, if I pay it all up front, what is my monthly and where do I actually, break even and start technically saving money?
Right.
Another thing to do is I've been seeing lately is people are getting seller credits a lot lately, and they're using that money to do the upfront PMI.
There
So,
you go.
like we just said, same scenario, just not out of their pocket. Now they're getting a $7,000 credit from the seller, and they're using that to pay the PMI upfront and not have the monthly PMI anymore on their convention. That now these are conventional loans. FHA, it's on there. You can't do anything
Right.
about it.
Now that the 1.75% upfront mortgage insurance premium can be covered by a seller credit,
Yeah,
or I think technically you could pay for it up front, like within your closing costs if you wanted to.
yeah.
But for the majority of FHA loans, it gets added to the loan amount and just paid over time. Um, but no, you can pay for that up front too. That could be paid and covered by a seller credit.
Now, one thing we didn't mention is VA loans. VA
What
loans,
mortgage insurance?
exactly. VA loans do not have monthly mortgage insurance. There is a funding fee for the VA if you don't have a disability at all. They will put a funding fee on it, which gets wrapped up into the loan, or you can pay it out of pocket, depending on there's a lot of different stipulations on what that percentage would be.
Right.
That's kind of like their mortgage insurance, almost in a sense. But then you also have like you have 10% disability, there's no VA funding fee anymore.
Right. But yeah, I mean that's mortgage insurance in a nutshell. For some people it's avoidable, some people not so much. But we've seen a ton of people that bought their first home, they pay the mortgage insurance, either conventional or FHA loans, and then after time either had it removed or potentially sold their home, had enough equity to then put more money down, pay less in mortgage, pay less in mortgage insurance, on the next house. So it's not, you don't have to pay it for every single home for the rest of your life. But it's there anytime you're putting less than 20% down. And I will add, we've been doing a lot more non-QM loans, but like on our bank statement loans, 10% down. Is there mortgage insurance?
Nope.
Nope.
Those
There's
are
not.
called those are the non-QMs are private mortgages. That's what people don't realize. They're companies out there that we write through or sell it to them. And so that what they do, it's a portfolio loan. What they
Right.
decide is what the rules on it.
They don't have to follow the Fannie Mae, Freddie Mac rules. So
Yeah, yeah, they decide on it. So it's usually how much does the person reserves they have. That's how they prove everybody. Like they look over a bigger picture of things.
right.
But that's PMI, like you said.
Mortgage
So
insurance. Super fun
so great.
topic today.
Yeah, great topic. Oh my gosh, so exciting.
You got anything else? That's all I had.
That's all I have on it. I mean, it's short and simple on this one.
All
Not
right.
much with it. So
If you have questions about mortgage insurance, let us know. We'd love to hear from you.
yeah,
Otherwise,
definitely if you want us to kind of look at your, hey, I have a mortgage, can you look at it? We'll look at your statement and say, hey, you probably get this removed. or
Yep.
look at anything. It doesn't. You don't have to be Florida for that. Anybody, United States for that.
That's it.
All right.
Until next time, thank you for joining us. This is the Brutally Honest Loan Officer Podcast. I'm Derick Brown. This is Stephen Brock. We'll see you next week.
See you guys.